makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Decision day for the Bank of England. Investors bet rates will remain at their 16-year high until November after inflation slows to 2% for the first time in almost 3 years. The revival of European IPOs is faltering, with the political turmoil in France hitting equity markets. We discussed that with the Euronext chief executive, Stephane Boujnah. Plus, more of our interview with Jim Ratcliffe, the UK billionaire and co-owner of Manchester United. He warns the Premier League is in danger of ruining its position as the world's richest football competition. Now, we'll talk about football in a second, but first thing is first, let's look at the European markets map. Now, there is quite a lot of news out there. First of all, it does seem that European stocks are strengthening. This is after the Swiss National Bank, the SNB, delivered an interest rate cut in a busy day for monetary policy officials in the region. Now, policymakers in Switzerland cut borrowing costs for the second time, basically saying that inflation pressure has decreased again compared to the previous quarter. The Swiss currency fell in response, and if you look at euro, also easing some 0.4% versus dollar. Now, a couple of other things we need to watch out for. Of course, today is BOE. We won't get a speech, but the Bank of England expected to keep the rate unchanged. And then Norges Bank also coming out, leaving that benchmark interest rate at 4.5% as expected. Now, in France, a big piece of news in France because the Treasury preparing there to sell as much as 10.5 billion euros in bonds for the first time since the President Emmanuel Macron shocked markets by calling a snap election. So I did tell you that it was a busy day. It is. The Swiss National Bank, again, cutting borrowing costs, again, to loosen constriction on the economy and stem gains in the franc, a move that contrasts with the hesitancy of global peers over easing. So joining us now is the perfect guest. We really planned this. The head of BlackRock Investment Institute, also a former central bank official, Jean Boivin. Jean, what a day to have you on. I mean, it's a big central bank day, and I don't know whether the driver is actually, the fact that there's two kinds of central banks right now, the ones that want to cut and the ones, the Fed, the BOE, that are a lot more tentative.
Yeah, I think the starting point for me is that there's a big anchor, and it's the U.S. The U.S. The Fed was very willing to try to engineer the start of an easing cycle this year. We've been very skeptical about this happening. This is certainly have been delayed. Other central banks, like we've seen today, can afford to cut somewhat, but we think they're going to be limited because that Fed situation is going to be a constraint for every central bank. So,
Jean, how do you see the Fed developing? And actually, is there a danger that, inflation kind of slowly comes down, but then really picks up by the end of the year?
I think this is a bit of the baseline scenario for us. Is we see, reason for inflation that continue to appear to go down somewhat, but underneath that, there's like real ongoing pressure, partly from services. And I think we're going to see the Fed getting close to the election. It's going to be a window that's going to close in terms of cutting rates. And by the time we get to the other side, inflation might be showing more persistence, even more than right now.
So do you think they cut?
I think if you have to make a likelihood of what's going to happen, I think one cut this year is pretty likely. But beyond that, I think it's difficult to see much more happening.
Why are we not talking about interest rates actually rising? Is that something for 2026, or is it just because, you take it off the table?
I think it's a great question because if you take it just purely from a public policy objective, the risks are pretty evenly, balanced on both sides of inflation, and you should keep some probabilities of hiking in a world like this. I think the reason why we don't put too much of a probability on this is because the Fed itself seems to be pretty much set to cut rates. There's such a willingness to move in that direction. They've signaled so strongly that I think it makes it less likely as a result.
It's less likely, but could it be a policy mistake that they're not even talking about a possible hike, given the the question marks about inflation?
I mean, in principle, it could be. I think at the end of the day, I think it's not much more hiking we would need anyway. So I think it's going to be more about the time that we can keep it there and for how long. So I think they can manage by holding it there as opposed to just hiking. So it's not a big risk if it won.
Jean, what will support these markets? So I don't know whether you're looking for a catalyst or just like, an anchor for it not to drop.
So for the market overall, I think the macro environment, both central banks, and if you think more broadly about inflation growth, that's not really the tease as a story for being bullish on market. I don't think it has been for the last few years, and we don't see that as being the story going forward. It's not an environment where macro is going to be your friend. Instead, it's more about these mega forces like AI that is really powerful. We clearly believe there's something big happening there, and that's where we see the reason to be bullish, overweight risk assets. So it's not so much about macro and central banks like it was for many decades, but now it's more about these big forces at play.
So again, AI, I don't know whether the stocks are priced to perfection and close to a bubble. I know NVIDIA pre-market is gaining, again, 4.1%, now the most valuable company in the world. Is there a point where you say, actually, they're just too richly valued?
Yeah, I mean, when you look at these specific companies and so on, it's pretty spectacular what you're seeing. You put it on a chart compared to other, growth companies over the history, and it stands out. So, I mean, that leads you to ask some questions. But at the same time, I mean, I think there's a real story. You look at earnings projections for these companies, and you look at the pricing. It's not like 2001. It's really, there's something behind that. Of course, we will see market that probably will get overextended at some point, but we are still comfortable with the overall valuation we're seeing there.
So I think you're overweight tech and the AI theme. Is it more Europe? I mean, Europe, just because of the nature of the economy, the proximity to some of the wars, valuations are a little bit lower. Is that how you play it, or you just go for the big seven in the U.S.? Actually, maybe the big six.
Yeah, or five, or we'll see. But yeah, no, it's mainly the U.S. Still to this day. I mean, it's true from a valuation perspective. You see more opportunities in Europe as a result, but the AI team is playing first in the U.S. I think a lot of investment is happening there. CapEx is being deployed. It's going to be pretty significant, and I think and there's a U.S. pole of attraction that is pretty strong there. So it's U.S. first. I think Europe eventually will benefit, but it's less clear for us now.
Yeah. But what industries will be disrupted the most? And again, can you play AI through disruption in industries, or is it a little bit too soon?
The other point I would make on AI is that, we believe it's a big story. How it's going to play out is, I think this is the biggest uncertainty we probably faced in my professional life. It could be extremely fast. It could be very low. Everybody's trying to make sense of it. So big uncertainty, I think, and the big question is how much is going to be augmenting labor as opposed to replacing labor. And that, I think, we're watching. So it's more about right now looking at the companies that can extract profits from the situation. The knock-on effect, I think, is going to be something we need to watch, and not the time to play it just yet.
Jean, overall, what region, I mean, I know you like the U.S. quite a lot. Do you believe that there could be, the end or a slowdown of U.S. exceptionalism? And does that impact the markets, or is it a longer-term kind of protracted story that we could see play out?
Yeah, I think it is the case that I don't think that reality has really sunk in markets yet, that we're on the other side of COVID now on a track globally that is much weaker than we were pre-COVID. The U.S. is the exception, so it's the one that is doing the best. But even the U.S. is on a slower track. So I think there is a structural story of slower growth, demographics being behind that, high debt. AI is the offset to this, so we'll see how it plays out. But in terms of other regions we are interested, Japan is for us the place where we have the biggest overweight right now in terms of risk asset equities. And the reason there is because that's the only place where we see the macro environment as being your friend, as opposed to other places.
And the U.S., how difficult is the U.S. to read, given we're also in a U.S. election with quite difficult blueprints, although no one's talking about the debt?
That's the elephant in the room, right? And it's very surprising that everywhere globally we have this is the year where there's going to be the most voters going to vote, and that fiscal policy is nowhere to be seen in any of these debates in every country. When does it come back to the fore? I think this is going to be a big question. I think will come back at some point. But when you think about the outlook for the U.S. in particular, both parties, no matter what happens, we're going to see in a high-spending world adding to a pretty high debt already. So this is why we think over time, long-term rates continue to go up, need to adjust upward, and long-term fixed income is a bit more cautious for us.
Yeah. Do you worry about treasury auctions in the U.S.?
Well, I think we're going to learn a lot about the ability of the market to absorb these auctions because there's a lot coming through. I'm not worried, but I think we see that as being a catalyst for higher rates at some point.
Jean, France, I mean, that's, the snap election certainly sent nerves across markets. How do you see that playing out, for investors? Is there an opportunity to get a good deal on cheaper French bonds?
Well, I think for now, I mean, the range of outcomes is much higher than it was before we got the snap election being called. So I think it's normal for the market to price in wider spread for France, as it has been the case. I'm not saying that being dislocated in any way so far. I think the risks are real. As we learn more about what the second round landscape would look like on the lead up to the election, then there might be a room for adjustment. I think the place where there might be more of an opportunity is on the equity side, because I think the rate side, I mean, there's a reason why they should adjust. On the equity side, European equities are not necessarily that concentrated on the European situation per se. There's a lot of global drivers, and there's a good chance that the equities will overreact to the election risk.
And so it's a good buyer opportunity, actually, if you want to get into French equities.
We're neutral, but I think this is one place where we're going to see an opportunity probably to step in if we see more aversion and worries start to move markets.
I mean, it almost sounds boring talking about the UK, given the relatively stability for the moment. Although we have an election, we don't know whether there's a majority or there's some kind of also having to share power. What's your take on UK assets?
Well, in the UK, it is indeed, compared to 2 years ago, 18 months ago, I wouldn't necessarily have expected the UK to be in a situation where inflation now seems to be progressing well, better than in other places. I think that makes the outlook a bit more positive in the UK. We're going to see the Bank of England today. Don't expect a big move, but I think they are in a position to cut eventually more. So that could be a positive catalyst in the UK.
I mean, we haven't really talked about geopolitics. We haven't really talked about private credit. But is there anything that makes you a little bit uneasy that the market is not talking about? I don't know whether there's liquidity concerns, but something that could actually surface.
I feel like the stance of most clients we have of the market is pretty cautious to start with. So I don't feel a need to emphasize like a big tail risk. I think that's pretty much in the mind of people. I mean, the risk is that inflation is not as settled as most people expect, and that could be a bit of a wake-up call if it happens. So that would be the place I would be a bit more worried. But I think that's also well understood.
Jean, thank you so much, as always, for coming on. That was Jean Boivin, Investment Institute, of course, director of BlackRock. Now, coming up, will there be a revival of the IPO market in Europe? We'll discuss that with the chief executive of Euronext. That's next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, volatility in Europe is forcing some companies to rethink their IPOs. Now, luxury footwear maker Golden Goose pulled its listing in Milan this week, and Spain's Tandem Brands is reportedly postponing its IPO until after the summer. And Paris, meanwhile, has lost its spot as Europe's biggest equity market to London, less than 2 years after winning the title. I'm sure there's going to be some pushback. Now, joining us now for an exclusive conversation is Stephane Boujnah, the chief executive of Euronext. Thank you so much for joining us, Mr. Boujnah. First of all, what kind of market do we have? So are we seeing green shoots of M&A, or are the IPOs being pulled doesn't bode very well in terms of trends for the future?
Well, I mean, overall, the market, I'm quite confident in the big picture. Here and there, we have a few companies that decided to postpone their IPO plans, but in reality, the IPO pipelines for Euronext, as it is for most of our colleagues across the continent, is very thick, and we are confident that 24 will be a very good IPO year. Things are transitioning in the right direction.
You're also celebrating your 10-year anniversary of being IPO'd yourself, Euronext, so congratulations on that. Do you think any of the IPO postponements had to do with the French market turmoil?
I don't think so. I mean, there is some questioning or there are some concerns because France is not used to snap election. It's very unusual. But at the end of the day, things will clarify in 2-3 weeks' time. So I don't think it is something which is fundamentally and structurally a source of concern.
But is there a concern? Do you have concerns? Emmanuel Macron rolled out the red carpet. I remember, senior bankers in London saying, we're going to lose people to France. Is there a concern that if there's a new government, when there's a new president, actually you lose some of the good stuff that you've had so far post-Brexit?
I don't think so. All the schemes that have been deployed, put in place, enacted to make France a very attractive place in terms of foreign investment have been there or have been deployed over the past 20 years through very different governments. They are part of the fabric of the French economy. I'm not concerned about these rules being dismantled in any way whatsoever.
So do you think all of this volatility, market volatility, will be short-lived?
Yes.
Why do you say that?
No, because I think things will stabilize. We are just in the middle of the campaign. There are uncertainty. The outcome of the elections are not clear. Rational people will prevail ultimately, because the closer we get to the elections, the less buzz and the more fundamental votes. And in any event, after the 8th of July, things will stabilize in a much more clearer environment. So I think it's not a fundamental structural source of concern.
I mean, the Total chief executive was pretty punchy, saying, look, he's looking at whether, reviewing whether it's better to list elsewhere because of, I don't know if it's a lack of capital or certainly this very green sentiment in Europe that he believes could be holding the Total share price back. Do you think such moves will be more prominent?
No, we are working with Total, and they have no plans to move their primary listing that will stay in Europe and on Euronext markets.
You know this for a fact, or because I thought they were
no,
doing
that's
the
what they
review
themselves stated at their general meeting. Oh. What is true is that they have a fundamental valuation gap, which has nothing to do with markets. The liquidity of the total stock is much bigger and much stronger in Europe than in the US. It's not a liquidity issue. It's a valuation gap for one simple reason. European investors do not like any more oil and gas, whereas US investors do like oil and gas, and the valuation of the peers of Total is much higher than the valuation of Total, because the investor base in the US of Chevron and ExxonMobil is much higher. So the question for Total is how to capture more US investors, because US investors like oil and gas, European investors do not like oil and gas. That's the only point.
It's a big point. I mean,
it's a big point. It has to be respected, etc. Yeah. But the listing venue is not the solution, and we are working with them to all sorts of mechanisms and schemes to fix the problem. And I think there will be a solution that will be found and will be convenient for the board and the shareholders of Total.
But so you see this as a real problem? That also, I mean, we've also heard, some rumors about Shell possibly looking at the same. Do you see a problem of, some of the big commodities, big oils leaving Europe, and how do you attract U.S. investors to Europe?
There is a big difference between the London perspective and the continental Europe perspective. Euronext, as you mentioned, it was created 10 years ago, was re-IPO 10 years ago. So the big difference between now and 10 years ago is that today the aggregate market capitalizations of companies listed on Euronext is about 7 trillion euro, which is twice the size of the aggregate market capitalizations of companies listed on the London Stock Exchange. The average daily volumes on Euronext in terms of equity trading is about 10 to 11 billion. So it's about twice the size of the equity trading in London. So in London, there is a debate on liquidity.
Yes. In
Europe, there is no debate on liquidity. Because we have a single liquidity pool with Euronext, a single order book, which is deep and liquid.
But
there are issues on valuation.
Concerns.
There are issues on multiples, which is totally different from the stock exchange and totally different from the liquidity issue. The issue is valuation and the size of the equity market. And what we need to fix is something which is broader than the exchange, which is how to make European equity great again. MIGA, how to make European equity great again. And there are all sorts of initiatives.
What would you do? One thing, the first thing you would do?
Total change of prudential ratios for institutional investors and total change of tax incentives that drive savings towards a public debt rather than equity. Prudential ratios, because 10 years ago, there was too much risk in portfolios, and that was the macro problem that led to the strengthening of the prudential and solvency ratios. Today, the macroeconomic risk is not too much risk in portfolios, is not enough risk in European portfolios. And that would be definitely a way to move forward.
Stephane Boujnah, thank you so much for joining us today. That was, of course, the Chief Executive Officer of Euronext. We'll have plenty more ahead, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, there's quite a lot going on in terms of currency and market moves because we had two big central banks actually come out one cut and the other one did not. Now, the S&B cut rates again. This is to aid the economy and try to help some of the gains in the francs or stem some of the gains in francs. Officials in Zurich actually lowered their benchmark by 25 basis points to 1.25%. Thomas Jordan, the president, said that the underlying inflationary pressure has decreased further compared with the previous quarter, owing somewhat lower second-round effects. So that's one thing to watch out for. We did also have a bit of moves on krone. Again, krone has been gaining. It seems now that markets have placed the bet that Norway is sticking with its policy rate for 2024. Now, this could always change, but the statement part that was interesting is they say that if the economy evolves as currently envisaged, then the policy rate will continue to lie at 4.5%. And then, of course, we have the Bank of England later, no change expected in rates. NVIDIA, though, shares rising as much as 4% in pre-market trading. We had a great conversation about AI and AI stocks with Jean Boivin from BlackRock. Coming up, why Manchester United's billionaire co-owner fears for the future of the Premier League. The exclusive interview is up next. This is Bloomberg.